Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and it is November 5th, 2025, and we are welcoming back to the show Joe Mazzola. He is the head trading and derivative strategist at Charles Schwab. Welcome back to the show, Joe. How you doing?
Thanks for having me, bud. Nice to be back.
Absolutely, and yeah, he's got his lovely guitar in the background. He was showing me some of his pictures, some great stuff, some great, almost like your own little Planet Hollywood there, or something.
Look, I enjoy it, but as I was telling you, Justin, I'm heading out of the Bay Area here in a couple of weeks, moving down to Texas. So I'm gonna have to wrap this office up and see how I can set it up down there. So
Yeah.
we'll see what it looks like down there.
Yeah, well, next time we have you on, then we'll get a whole new experience from you.
Hmm.
So, Joe, there's a lot of stuff to kind of cover in terms of the way the market has been.
Yeah.
There's certainly some fear out there, and like, hey, a lot of kind of what seems like intraday volatility.
Hmm.
But man, it's hard to complain when we're only a couple percent off the highs. Where do you want to start? I mean, there's volatility, there's the 10-year Treasury yield, there's the Fed and how things shifted recently there, and not to mention all of the data that's missing. So, what does that December Fed meeting look like when it comes
Yeah.
around if they don't have data to work off of? But maybe we start with the 10-year Treasury. How about that?
Yeah. I mean, Justin, the move that we've seen prior to the Fed meeting last Wednesday, when we were below 4% on the 10-year. Here we are, what, 4.16? I mean, just a 7 basis point move intraday today.
Right.
It just kind of goes to show that these, as the bond market becomes more volatile, we're starting to see more volatility in the equity markets. I think it's an important connection between the two. 'Cause what I think you need to really see is you need to see the stability in the bond market in order for this rally to pick up that next leg forward. And it's interesting because the market wants its rate cuts, but it also wants good data too, right? And it wants good data because of the fact that so much of the move in the market was predicated on the mega caps, right? Which is that first leg. In order for it to really take that second leg, in my opinion, you need broader participation, and the
Right.
only way you're going to get that broader participation is if you continue to have good economic data. That's what's going to lead to a broadening within other sectors. That's what's going to lead to small caps and mid caps participating, which they haven't as of late. That's what's going to help the overall market. And in all fairness, we got some pretty good data today. The ADP private sector
Right.
jobs data came in better than expected. Another thing that I noticed as well too is the ISM services data came in better. The caveat there being, Justin, was that prices paid was the highest we've seen in 3 years. As soon as that number came out, boy oh boy, you could really start to see those yields start to pick up.
hmm Well, and it's funny that you bring up, again, usually what happens is you get higher yields, and that does put pressure on the small cap
Mhm.
indexes because, look, they rely on debt, and you change things just a little bit, and that
Yeah.
makes a big difference. But the Russell 2000, explain this to me. Why was this up 1.5% with the yields coming up so much?
Yeah, no, I think it's a great question. I wish I had I wish I had the exact answer for you, but I'm going to give it a shot. How's that?
Okay.
I think a lot of the move that we saw back. I mean, look, it's been about a 4, almost 5% pullback from the Russell from
hmm
its high. And remember, the Russell was the last of all the indexes, to push into new highs, 52-week highs. And then it started to pull back first too. And it's the first of the indexes to test the 50-day moving average, even as all of the other indexes, they pulled back a couple percent, tested the 20 days, and it basically held. You saw the Russell kind of give it up first, right?
hmm
It was the last one to get there and the first one to give it up. So some of that has already been priced into the move. But it wouldn't surprise me if we continue to see maybe a pushback up to 4.2, maybe 4.25, which had been the resistance in the 10-year. If we kind of go up above that, it's going to have, or it would likely have a more of a detrimental effect on these small caps. And remember, just kind of looking at the charts overall in the 10-year, It looks like we have the potential to be breaking out of a longer term downtrend or longer term down channel, if you will, that started way back in May. And if that's the case, there could be some room for this thing to run up. And I guess if you're the government and if you're the Fed, you're hoping that doesn't happen, but we'll see.
Hmm. No, absolutely. Now, you also mentioned breadth, and so it's not just the small
Mhm.
caps that are, again, a little bit off from everything else, as you said, pulling back a little bit more to their 50-day as opposed to the 21 days or 20 days. But
Yeah.
one of the things I've also been kind of looking at is the Invesco S&P 500 equal weight ETF. So same
Okay.
stocks that are in the S&P 500, just when you take away the $1 trillion club dominating, this has a little bit of a different look to it. This is also
Yeah.
actually spending quite a bit of time below its 50-day moving average line. So when you see that kind of equal weight, the average stock, if you will, uh, all the way down here, and a lot of stocks actually below their 50-day moving average lines.
Yeah.
What is that telling you? Is I mean, certainly the Mag 7, did all the heavy lifting pretty much in 2023, but is it fair to say, oh, you guys got to do it again?
So, a couple things. The word that comes to my mind is dispersion, right? Dispersion is basically how many of these different data points do you have around some type of a mean? And that dispersion is getting wider and wider as the days go on, just because we're seeing, as you mentioned, Justin, so many of these different names that are underperforming the S&P 500 as a whole. I think at this point, there's only 15%. Yeah, 15% of the S&P 500 has outperformed the overall index. Think about that.
Yeah.
15%, that means 85% have underperformed the overall index. How does that happen? Well, when you have a market cap weighted index like the
Hmm.
S&P 500 does, and you look at the top 10 stocks that make up 40% of that market cap, they don't even have to be in the top 10 or top 20. Here's another interesting fact for you, Justin. If you look at the top of the top, right? So Nvidia is the
Yeah.
top performing within that Mag 7. It's not even in the top 40 of the S&P 500 stocks year to date in terms of their performance. But the fact that it's a $5 trillion company, it means that it kind of outpunches the rest of the names within that index, and you're starting to see that. And what kind of sends up a little bit of a, I don't want to say a red flag, but maybe how about an orange flag? We'll call it that.
Okay.
As you think about Q4, right? So we're finishing Q3 earnings right now, and let's be honest, they've been pretty darn good, right? You have B
Hmm.
plus, A minus, whatever you want to call it. But as you look into Q4 or you look into Q1 of 2026, expectations are that there's going to be a shift, right? So as you mentioned, Justin, the Mag 7 or the top 10 stocks, they've been doing the heavy lifting. There's expected to be a shift in terms of earnings from the Mag 7 to the other 493. Where it's the other 493 are expected to catch up, or the top seven are expected to kind of catch down, if you will. What does that mean? Well, if we're expectations where we're at right now, and you saw kind of what happened last week when we had five of the Mag 7 come out. For the most part, they were all really good earnings.
Hmm.
But investors were very finicky and were very fickle. And some of those names, whether it be Meta, Microsoft, they didn't hear what they wanted to hear, and they punished those stocks pretty handily.
Yeah. And I mean, speaking of Meta, one of the big things, of course, is their CapEx spending, which it's a mixed bag, right? For Meta, it got punished, but a lot of other stocks, oh, hey, more CapEx spending on AI, and Meta really kind of leaning
Hmm.
into that. It really kind of sent a lot of other stocks in the other direction. So I guess, how are you viewing AI and its influence right now? I mean, certainly it's been tricky because even getting diversified is tough because now utilities are kind of
Oh
AI-ish.
yeah.
Heavy construction. Well, the data centers, I mean, even like some of the REITs, they're data center
Hmm.
REITs, and so it's almost it seems like anything you invest in some ways is kind of touched by AI, and the correlations are going up. Those correlation coefficients are going up to zero
Yeah.
point 0.9 in a lot of cases with things that were typically uncorrelated. So does that add an extra level of kind of trickiness, I guess, to diversifying your portfolio.
100%,
Mhm.
100%. Like if you're to look at sectors that have the highest percentages of stocks above their 50-day moving average, it's utilities.
Yeah. Hmm.
Not think about that. Not IT, utilities.
Right.
Why? Because utilities are now kind of pseudo IT, right? Or
Hmm.
pseudo AI ancillary plays. You look at one of the best performing stocks in the S&P 500 year to date is Constellation Energy Group.
Hmm.
And so these are names that you wouldn't necessarily attribute to high volatility or high beta, but they're becoming that way, right? Because
Hmm.
they're the ones that are feeding the energy needs of the hyperscalers. And when you start to think about that, and I think Justin, one of the things that came out of the Meta earnings report, and maybe right afterwards, was there was an inflection point in the funding that we're starting to see. So up to this point, the majority of the AI spend had been on free cash flow. It had been on companies that had sterling balance sheets that were sitting on billions of dollars of cash and saying, where can we get a good return on that invested cash? Well, we started to hear something different this time.
Hmm.
Meta said for the first time, you know what, we're going to look for financing in the debt market. We got
Hmm.
$30 billion of debt financing that we want to do. Now, in all fairness, that is a drop in the bucket for a company of that size, right?
Right.
A multi-trillion dollar company. So it's not a big deal in terms of debt financing. It's just it's the difference in how they're approaching it now because there's a little bit of a cash burn. You saw the same thing from Alphabet earlier in this week. They also are going to the debt markets to raise capital for their AI and their CapEx spend. And I think that's a little bit of a difference in, like I said, maybe an inflection point, if you will, in terms of maybe how investors are looking at things, because now they have to add that to the equation in that return on capital invested amid falling cash stockpiles from the companies that we just thought would never burn through that cash.
Right. Yeah. Again, when your cash is that large, it's such a mountain. It's and that's what in 2022, when
Hmm.
all of these were, you know, when the rates were going up and the rate hikes and everything like that, those were the ones that seemed to be insulated. And again, that kind of explained why they
Absolutely.
were doing so well in 2023 and everything. Why the Magnificent Seven became a buzzword for everyone to use. But yeah, definitely. Well,
Yeah.
and something you and I were talking about in the pre-show, Joe, that's a little bit interesting is a lot of people are talking about how the how much money is on the sidelines, whether it's in money markets and stuff like that.
Hmm.
And you brought up a good point that, well, it's not the money markets of 10 years ago when your return or your
Yeah.
income from that was 0.1%. Now it's like, well, 4%, that's not nothing. So I guess on the flip side, for those that are using money markets now or fixed income to kind of say, hey, this is a non-volatile asset that I can use as part of my portfolio to diversify it. How much of that do you think is going on?
So here's the thing. Everybody keeps saying they're waiting for that cash to make its way to the market. And I'm saying that, yeah, maybe it has. Maybe it has in other investable assets.
Hmm.
Maybe money markets, maybe cash on hand or some way that, people are using that as a way to get a 3.5%, 4% yield. Maybe that's just a new part of the portfolio. Maybe that's a
Yeah.
new slice of that portfolio pie that might not make its way back into the equity markets. And I think that is something that, as we think about portfolio construction and allocation, that kind of harkens back to, when I was in B school and they were talking about, hey, what is it? It's not just the 60/40, it can be the 60/30, 5 and 5, whatever
Hmm.
that construction is. But I think that we do need to consider that that's part of that pie now.
Yeah, and again, it's kind of uh, the the old rules coming back into place because I mean it was really
Hmm.
unusual for us to have such a prolonged level of such low interest rates. I mean, that was the
Yeah.
anomaly. And now again, this is what everyone's been talking about, normalizing things, and different people are have different thoughts on that and how good that is for the economy. But it certainly is. Maybe we have to go look at some of those old modern portfolio theory books from the
Little
70s.
Markowitz for you there,
Yeah,
Justin. Little
right,
Markowitz.
exactly. Yeah. So
But think about it this way. There's a good percentage of the investing public that's never invested in that type of
yeah,
a scenario, right? They
yeah.
haven't been part of that, which is really interesting to me. When we look at our new accounts, a good percentage of them are 40 and younger. I mean, so there's a lot of new accounts that are coming into Schwab that haven't seen that type of environment, with 4 or 5% interest rates, 6 or 7% mortgages,
Yeah.
8% mortgages, wherever it's going to go back to. They just haven't really lived through that in terms of kind of what that means to their investing portfolios. So it'll be really interesting to see kind of how they adapt. One of the things that has been the case really all year has been the dip buying on pullbacks, right? And it
Hmm.
doesn't matter kind of what age group investors are. That just has been something that's really kind of permeated through this entire cycle. Is that even going back to April, it was the retail customers, the retail client that were the first to step in. And
Hmm.
they've been right the majority of the year. And so what's happened is you've gotten these shallow pullbacks, just shallow pullbacks where they're stepping in and buying it up, or 3 or 4% pullback over a couple of days, and it hasn't really extended. It'll be interesting to see if that's the case again here.
Hmm.
So
Right.
what we can do is we have some insights into kind of some of the buying activity, and look, we continue to see investors step in and buy, those large mega cap stocks that have just done the heavy lifting, as you mentioned earlier.
Hmm. And it's funny that you mentioned that, because back in 2017, I remember that was one of those markets where it just really didn't have many pullbacks. I think the S&P
Mhm.
500, the sharpest, or the deepest pullback, I guess I should say, was 3.4%.
Yeah.
And anyone waiting for the pullback to get worse than that was sorely disappointed. It just kept on kind of going. Now, I feel like there was a little bit more sector rotation underneath the surface back in 2017, but
Yeah.
yeah, it's kind of interesting uh, how how that dip buying is. Now, I also want to kind of bring up, because when I first started, it was in the late 90s. So of course, I went through my phase of, oh my gosh, I'm so smart, I can't do any wrong. But I was also listening to a lot of what the analysts were talking about at that time.
Mhm.
Certainly in
Yeah.
1999, if you want to party like it's 1999, the dip buying was a very strong part of that. The Nasdaq, or everyone was saying, you just buy Yahoo on the dips, you just buy Cisco on the dips, and that was the strategy. Of course, that worked fine until it didn't.
Until it
So,
didn't. Yeah.
yeah, right, exactly. And then when it didn't work, it was horrible, because things were coming off 90%,
Yep.
even the darlings. But do you fear, especially because we have AI, like we had the internet kind of rolling out then? Does any of that kind of give you pause that dip buying is becoming a mantra again?
Uh, I mean, look, my job is for everything to give me pause, right? I mean, that's kind of, how I look at the market. Being my background in options, right? I'm always, looking at hedging activity, and I'm always looking at, when things look a little bit stretched in terms of, do we see people buying calls in rallies, buying stock and buying calls, and kind of double dipping and hoping to participate in try to capture as much upside as possible? Do we see them rotating into the meme stocks? And yeah, we've seen that through fits and starts of this market rally since April. When you look at kind of the May through June through July season, some of the best performing stocks were the non profitable tech stocks, were the heavily shorted stocks, were the meme stocks. And that only carries so far, right? You
Right.
know, and then they start to kind of roll off, and you look for that next leg, and where is that going to be? I will say
Talking about
this, and
some
I think
like,
this is
are you
interesting.
talking about like some of the quantum computing, that
Oh
kind of
yeah,
stuff,
oh for sure,
right?
absolutely,
Yeah,
yeah.
yeah. So
Yeah,
yeah,
I
go
mean,
ahead.
even to this day. No, even to this
Hmm.
day, that you still see those as the kind of the, you know, whether it's the quantum stocks, whether you know, there's a lot of different of those kind of new pockets, those meme pockets where, you know, there's interest in. I remember seeing one of them. I won't say the name, but it was basically 60 million in revenue
Uh-huh.
and like a $10 billion market cap.
Yeah.
And I was just trying to wrap my head around that, and I was like, wow, that's you know,
Yeah.
you're anticipating a lot of upside, right?
Yeah.
And some
Yeah.
pretty substantial revenue and earnings growth. But here's an interesting statistic for you, and this is kind of goes to what you were talking about, Justin, the churn under the surface, right? And I used
Hmm.
that word dispersion before. S&P 500 is up, you know, basically 14, 15% year to date. If you look at the average member maximum drawdown, so from peak to valley, right? From the high point to the low point. The average member maximum drawdown in the S&P 500 from its year-to-date high is 27%. That's not one or two names. That's the average across the board.
Hmm.
And you still have an S&P 500 that's up 15%. That just goes to show you that the generals, right? You know, those big the big mega caps, the generals are leading the way. The soldiers aren't necessarily marching in step. And at some point, are the generals going to be able to hold up that weight, right,
Hmm.
of the whole market? Up to this point, they have. But I think one of the things that was a little bit different that really kind of caught my eye last week, and this goes back to what we were talking about with Meta, Microsoft, and so on. Um, the expectations are higher right now. They just are.
Yeah.
And you're not getting rewarded for the beats, you know,
Hmm.
that you did before. Yeah, look, overall, this earnings cycle, as I said, B plus, A minus. You know, you can't take anything away from it. You got an 82% beat rate on earnings. Yeah, you know, you're up around 70% beat rate on revenue. Those are really, really good numbers. I mean, really good numbers, and that's pushing us in line for about a 12% year over year quarterly growth. Now, the difference between this quarter and say the last two quarters is expectations were much higher. They're around 9.5, 10% for this quarter versus Q1 and Q2 where they were in that 6 to 8% range. You know, for expectations of, you know, year to date or year over year earnings growth, the bar is getting higher. We're still crossing it, but the distance between, you know, think of a hurdler, the distance between that leg and that bar is starting to shrink, and that's why you're seeing the market, you know, start to. Uh, I, I don't necessarily, I don't know if you want to say roll over, but at least consolidate in this area.
Hmm. Yeah. A little bit more of kind of like that churning action.
Hmm.
We get stuck at these areas, right, where it is trying to get above it, but just can't seem to quite get there. And while we're talking about kind of churn and stuff that happens under the surface, I want to just talk a little bit about the VIX, the measure of volatility.
Hmm.
Of course, it's also known as the fear index, which is basically, again, measuring implied volatility for the S&P 500, going 30 days out. And we've seen some spikes, certainly news related. Oh, President Xi is saying this and President Trump is
Yeah.
doing that, and boom, volatility spikes because there's a lot of uncertainty, a lot of fear. And then it comes right back down, things get resolved. I mean, we see here, of course, the peak was around 60 for the VIX when a lot of the tariffs were first coming out, the Liberation Day, and then
Hmm.
as things were, oh, we're going to be pushing it back a month or 90 days, what have you. So how are you viewing the VIX right now, and what is it telling you? How do you use this for your market analysis?
If you go back to even just the tryst, if you will, between President Trump and President Xi when he got around 25, 26 in the VIX,
Hmm.
you know, that basically is pricing in, you know, over 2% moves on a daily basis.
Hmm.
You know, now we're back to a level where it's around a 1% move on a daily basis with the VIX around 17, 18, a little over 1% expected move. Um, and what's interesting is we had seen this for a while where the fear gauge was getting to a level, and remember, when we're looking at options, options are really priced off of expectations, right? If you're expecting big moves, you're willing to pay more for options. If you're
Yeah.
not expecting the big moves, and you see that implied volatility go in because people aren't willing to pay as much for options. And so when those expectations for moves are increasing, option prices are increasing, you see the VIX increase for expectations for a big move to the downside. Well, here's the thing. We haven't gotten that big move yet, or at least not since the rally kind of kicked in back in April. But what's been interesting is on just like we've had pullbacks in the market where we kind of get these like small little pullbacks and then it kind of firms up a little bit in the overall equity market. You're kind of seeing that in the VIX too. So the VIX is pulling back. Yes, we're not at the 25, 26 level that we were a couple weeks ago, but we're also not back to the 14 level where we were kind of midsummer. We're kind of vacillating around 17, 18. And if you were to look at the VIX on a chart as you got up right there, it looks like it's kind of a higher low, in trend in that VIX right now, where we just haven't kind of got back down to those yearly lows. So what's that telling me? Well, think about what we got through last week, right? We got through a Fed meeting. We got through Trump's trip in Asia, and we got through 5 of the 7 mega caps, or 5 of the 7 of the Mag 7 earnings, all within 1 week. And volatility really didn't break that much. The VIX came down a little bit, but it's still kind of a bit elevated. Well, what do we have this week, and what do we have going forward? Well, we have the tariffs are in front of the Supreme Court right now. We still have earnings. We're not done with this. And here's the thing: we are out of that sector of earnings where the expectations were really good and we beat them, right? Financials, right? Financials is always the first week or two of that earnings cycle. Earnings were good. They weren't really rewarded that much. Now we're in that kind of tech phase, or we're kind of making our way out of some of that, the big tech phase, where 5 of the 7 have already reported. They looked really good, but they weren't all rewarded for that. Now we're starting to get into that discretionary phase, right? Now is when we get into, your Home Depots, your Lowe's, right? All of these consumer discretionary stocks, your retail stocks. You start to look at the hotel stocks, all these things that you kind of move past hey, this is big business spending, and now we're looking at household spend.
Mm-hmm.
And what we've seen with the household is it's really been what we call this bifurcated market, where the people that have the discretionary income, the people that haven't been affected that much by the higher tariffs, they continue to spend. But there's this this quartile, that lower part of the K, if you will, that they're really getting hurt, by the tariffs, by the higher prices, and now they're getting hurt by the government shutdown. So it's going to be really interesting to kind of see how those retail earnings play out, how much of that is baked into Q3, or how much of that is going to be rolled into Q4. So that's what I'm going to be kind of watching here, because I think the VIX is just telling you right now that we're not quite out of the woods just yet.
Yeah. And look, to your point, I mean, it's real interesting when you look at the sector spider ETF, XLY. It looks like, oh, well, everything's fine, but that's Amazon and Tesla
Right.
having a 40% weight that's kind of hiding a little bit. If you, again, go to the equal weighted RSPD, that's a little bit of a different picture. That's
Yep.
well below its 50-day moving average line, and certainly there's some of those areas. Whether it's some of the retail restaurant stocks. I mean, Chipotle. That's been suffering. I mean, Kava was a market darling for a while, and that's been under the 200-day for months.
It could do no wrong for 2 years, right?
Yes,
Now, yeah.
exactly. Right. And there's just a whole host of Eat, Texas Roadhouse. You go on down the list, and there's just a lot of these that are well below their 200-day moving average lines, with no signs of recovery at this point. So yeah.
And Justin, if I can kind of speak to your viewers here, or your listeners, I guess, right? I think what you're pointing out right now is critical. When you start looking at these equal weighted symbols and compare them with the market weighted ones, and you'll see the difference, and you'll see just how much of that dispersion that we continue to speak to is occurring in the markets right now. put those symbols in your watch list, everybody, so you can kind of see the difference between the two. And it's striking. It really is.
Hmm. Yeah, and no, absolutely. I use Thinkorswim, and I probably should disclose at the outset. I do
Mhm.
use Schwab as my broker. It was TD Ameritrade. Schwab bought them, and so now I'm Schwab. So
Now you got me.
right, exactly. Now I got you. But I do have one that is all the sector spiders, both
Mhm.
the equal weighted, and I just have a watch list in Thinkorswim where I can
Yeah.
kind of see those differences. But let's maybe talk a little bit, just again, maybe the sentiment part of things, because it's been interesting how much fear, I guess, there has been. I mean, not the VIX. I mean, the VIX, as you pointed out, really has done remarkably well in terms of a lot of these headlines. But there's a lot of other things out there, AAII,
Yeah.
CNN fear greed index. There's all these different things that have shown an oddly high level of fear for a market that's within 2% of its highs. What
Yep.
do you attribute that to?
So we have our own versions as well
Right.
too. We have our quarterly trader sentiment survey, which is basically what are they saying, and then we have
Mm,
our monthly stacks or the Schwab Trading Activity Index survey, which is what are they doing. And here's the interesting thing: they're saying one thing and doing another,
mm,
right? So they're saying, hey, we don't feel really spectacular about this market right now. We think things are overvalued. We think the AI trade is overdone. But what do we do? Well, we buy dips in Nvidia, we buy dips in Meta, right? We, you know,
uh-huh.
we buy dips in the AI trade, even though we think that it's overpriced. This is what we do. And what we tend to see with kind of an active investor base, which is that's basically our clients, right? Not all of them, but we got a good chunk of people that like to be active.
Mm-hmm.
Is they look for the dip buying opportunities, they look for the pullbacks. If you look at Meta as an example, you get the 12% pullback off the earnings, and that just happened to be the week that we saw the most activity on the buy side.
Mm,
And they're looking to buy the dips and sell the rips, and that's kind of something that just has really continued really since I've been kind of following the study the last couple of years. And that is just a signature of what we tend to see from our traders. But I think one thing that's been interesting in this go around, this last survey that we got, there are other things that are kind of bubbling up a little bit. The idea of stagflation. We hadn't heard that word in a while.
mm-hmm.
So we heard it quite a bit in the springtime, right, with the tariffs announcements, and that was something that just kind of dissipated, and
Mm-hmm.
starting to hear that more and more. Hey, we are concerned. We're concerned about the lack of job growth. We're concerned about the lack of economic growth, and we're concerned about the fact that prices aren't coming down as much as we hope. Here's one thing that's really interesting. You and I had talked about this a little bit earlier before we got on the air. One of the things that it's been difficult for investors to do is try to find that macro data, right? Because you're not getting the CPI,
Yeah.
you're not getting the unemployment numbers, that are
Labor numbers
released
are coming
by the
from
government
private sector,
agencies.
ADP, right?
Exactly. Yeah,
Yeah.
the numbers are coming from the private sector. So they're there. You
Yeah.
just got to know where to find them, and you got to know what to look at. So today, perfect example. ADP comes in better than expected. Market likes that. And then about an hour later, or 2 hours later, you get the ISM services number, which shows that there's expansion. Expansion's good. People like that. Until you dig a little deeper and you see that a big chunk of that was the prices paid component, and shows that prices paid were the highest on the services sector in the past 3 years. So what does that mean? Well, when we had CPI data, right, when that's what we were using for our measure of inflation, CPI data looked like it was coming down. Why? Just like you talked about the fact that the discretionaries, 40% Tesla and 40% Amazon. If you look at the CPI data, a big chunk of it, I think around 32% of it, is made up of the housing sector. Well, housing prices, if you look around the country, they've been coming down,
Mm-hmm.
or they flatlined, and in certain sectors where they ballooned during COVID, they've come down quite a bit, and that's actually one of the things that during that COVID run held prices up higher is because you hadn't seen that rollover in the housing prices. Well, now you're seeing it. And what that's doing is that's masking some of the other things below the surface that are holding firm, consumer goods, right? Things like that. And so while it seems like the CPI data might be pointing to the inflation is measured or at least kind of under control, so much of that is kind of in the housing component of it, that when you look at other data, like we looked at the ISM today, or when you look at things like some of the regional Fed data, whether it's New York, Richmond, whatever, those are showing that prices are holding firm and starting to kind of go back up again.
Yeah. So, Joe, what does that do for, I guess, the Fed meeting in December? I mean, the last Fed meeting,
Yeah,
it was a little bit of a shock, I guess, to investors who were
cold
counting.
water.
A little cold water as they were
Yeah,
counting on that cut. At being kind of a lock. I don't remember if it was all the way up to 95%, but it was above 90%
yeah,
for the Fed futures. For December to be a cut, and that quickly went down to 70, 65.
yeah.
And so
I'm shocked it's still there.
right. So now with kind of spotty data or a little different data. How does the Fed do their job exactly in terms of
Hmm.
making a decision in December with a shutdown going on as it is?
That's a rough one. I mean, I don't envy Chair Powell with that, especially kind of with what he's dealing with some of the kind of internal dissent. I mean, look, I think it's healthy to have dissension amongst the
Hmm.
Fed, right? Because you want to have varying opinions. You don't want everybody kind of falling in line. I think that's a good thing. What I do think is difficult, though, is as you mentioned, without the data, and then fighting really a battle on two sides, right? Remember, the Fed has two mandates:
Hmm.
control inflation and keep people employed. Well,
Hmm.
what's interesting is if you look at the unemployment number right now, around 4.3%, what you can do is you could look back at that and say, wait a minute, this is basically a fully employed economy. What are we concerned about?
Yeah.
Well, remember, even though the labor demand has gone down, the labor supply has gone down too. So, some of the effects of the border policies and immigration policies have lowered the labor supply. So that equilibrium's lower.
Hmm.
So if you had the same amount of people here in the country, that an unemployment number would be higher than 4.3%. It absolutely would, and there's no debating that. And so, yes, once again, there's some of this engineering that's kind of happening with the numbers that I don't think is really pointing out to maybe the slowdown that we're seeing, and maybe as quickly as it's happening. And I do think that the Fed is in a tough position because they're trying to stimulate the economy and make sure that there's a soft landing ahead. But at the same time, as prices are going up, it's kind of pushing them in a little bit of a corner. And now you're starting to hear talk of like, well, 3% is okay, right? 3
Hmm.
3% inflation.
Right. It used to be
Yeah,
like, no, 2%, that's it. We'll accept
yeah.
nothing less. And yeah,
Yeah.
okay.
Well, and 2%, there was plenty of years where 2%, we didn't see inflation at 2% in the US. Why? Because we at that point we were importing deflation, right? Because of our trade policy had become so globalized that we're importing deflation from other countries. Which was keeping our inflation down, which meant you and I could go to Best Buy, go wherever it was, and buy really cheap electronics, really
Right.
cheap goods, really cheap clothes.
Hmm.
Well, that's changing now, and so it's having an effect. And like I
Hmm.
said, the hard part is the people that it's hurting are the people that have the least amount of disposable income, and that and,
Right.
and that's a shame.
Yeah, and it's funny when you were talking about the Fed. Again, he's kind of fighting two fronts. It was interesting that this last one, someone wanted a 50 basis point cut, and
Mhm.
someone wanted to stay, pat. And I was almost thinking,
Yep.
oh, is Joe going to say dispersion again? Because I was ready for it.
Did you
Um,
have that on your bingo card?
right, exactly. Yeah,
Yeah.
yeah. So, before we go, Joe, this has been great. I can talk, on the macro side. I never took anything beyond high school economics, so I'm still like learning from people that actually went to business school and took those classes. But I
Mhm.
also want to get into some stocks with you as well. And
Yeah.
one of the things that we were talking about is, and you mentioned this earlier. Hey, you're the head of the derivative strategies, and that means with an earnings season still in swing, you're looking at these higher implied volatility numbers as the uncertainty
Yeah.
rises. Hey, I mean, you talked about the good side. There's been a lot of 10%, 20% gainers, but there's also been some like Meta where they get just clobbered, and even they start one way and end the other, which is
Yeah.
even
Oh,
more
AMD
fun.
today. Like, look at AMD's
Yeah,
trading today. What really interesting. I mean, overnight that thing looked like it could go 6, 7%, even 10% down. Kind of if it followed right the same path of some of the other semiconductors that had reported. I mean, well, look. Number one is they reported really good revenue, really good earnings, and actually a pretty darn good outlook. It's just these stocks are priced for perfection right now. Let's
yeah.
just be honest. That's the hard part is they have to meet, they got to beat, and boy, do they have to raise. And
Hmm.
that was the case where they checked off a lot of those boxes. And I think what happened throughout the course of the day, and you could see that just in terms of kind of that last bar there, is that we started down and throughout the course of the day just built up some momentum and kind of rallied all the way through. Now, the close wasn't as strong for the market or wasn't as strong, for some of these sectors as well. But overall, yeah, there's just been a lot of volatility around these earnings.
Absolutely. So, what is a trader to do? I mean, again, because
Yeah.
you had the derivatives, certainly options can come in because they are tied to that implied volatility. That's part of the price, right? If you know your deltas, not your deltas, your Greeks, then that's part of the
Mhm.
formula there, the Vega. So, how are you kind of approaching earnings in a way to, I guess, sometimes hedge, a position that maybe you want to keep, but
Yeah.
you just don't want that volatility. You just want to survive, and sometimes that's what it's about. You want to survive in the position so that you can get the long-term capital gain or what have you, whatever your strategy is.
Yeah.
So, what are some of the strategies that you're kind of sharing with your folks there at Schwab?
Sure. Well, I mean, one of the things is we do a lot of spread strategies. We talk a lot about, whether they're selling put spreads, selling call spreads. When you have implied volatility high like it is right now, spread selling strategies tend to pay you a little bit more in terms of the credit. I think the hard thing sometimes with the spread selling strategies is when you get that outsized move, right? When
Yeah.
you're when it moves beyond what the market's expecting, as Meta's being a perfect example. Those spreads can widen very quickly. So
Hmm.
it's a bit of a challenge sometimes to do so. The other thing we look at is like time spreads, like calendars. Calendars tend to do well when volatility is beginning to expand. And if you can find, if you believe that maybe a stock that you own has the potential to sell off, but as you mentioned, you don't want to sell it. Buying a put calendar is a way to kind of lessen the blow of that pullback without you having to sell the stock out. The hard part is this: if you just buy options, right? If you're looking to just hedge an option just by buying a put against some of the stocks that you own. Remember, when you go into earnings, that implied volatility goes up. And another way to kind of think of implied volatility is just the price, right? So you're
Hmm.
you're spending more for that hurricane insurance right before it's about to hit the coast, and that
Right.
that's really what it happens during an earnings cycle, is that the cost of these options goes up. So there are things that you can do, and one of the things that I tend to look at in terms of a hedging strategy is collars. And I don't employ collars and I don't recommend collars all the time. But if you
Hmm.
if if you got a stock that's been really volatile, and here's the kicker: if you see that the call prices are getting bid up, meaning that people are willing to pay more and more for that upside, you can do something like this. You can find collars on stocks where there's zero cost,
Hmm.
equidistant, or in the case of the example that I showed you, or that we can talk about here, you can find it where you can actually get about a $8 move in protection, and give yourself $10 upside. So there's actually a little bit more room for the stock to run before that protection kicks in on the downside. So that doesn't happen very often, but it happens when you see what we call skew, when traders are willing to pay more for the calls than they are for the puts.
Mm-hmm. So
there you go. You got
walk
a
us through.
technology.
Walk us through, because
Yeah,
not everyone
exactly.
in our, we're very stock focused, so not everyone's going to be familiar
Yep.
with the callers. We do talk on our shows a lot, especially Harold Morris,
Yep.
one of our panelists. He talks about spreads all the time. He loves his credit spreads, especially. But so what is a
Yep.
caller? And I'm also going to ask you to define call skew so that we know what we're talking
Sure.
about here.
You got it. You got it. You got it. So a collar is basically a combination of a protective put and a covered call, if you will, right? You own the stock, you buy a put, and you sell a call. And the idea is you're financing buying that downside protection, right? Because if I'm buying a put, it's basically what you're saying is, if the stock goes down to this level, I want to have the right to sell it. I want that protection to kick in. So that is what your long strike would be. Is that's the put that you're buying. You're selling the call up above where the stock is currently trading, and you're doing that as a way to use the credit you collect from that call to pay for, to finance the put that you're buying. Now, in normal circumstances, we have what we call investment skew. And so we'll get to kind of the definitions here, Justin. So investment skew means this. If you think about traditional portfolios and who's the bigger players in the game, right? Whether they're insurance companies, whether they're pension funds, whether they're hedge funds, traditionally they own stock. They're long stock. And they protect that stock by buying puts, just like we talked about, creating that floor to where they have that protection kicking in. Well, in order for them to pay for that floor, that protection that they're buying, they tend to sell calls up above to help finance that. Now, if you do that enough times, right, that put's going to be more expensive than the call. So you start to see what we call put skew or investment skew, meaning that people are willing to pay more for the protection than they're willing to collect, for that premium that they're signing the call. They do that because, think about it this way. The market takes a staircase up and the window down, right? That's what tends to happen. So they want to protect against that catastrophic drop out of the window. That's why they're buying the puts. What happens when you get this call skew is, and you can tell I'm Italian, you can see by the hands here, right? They start to kind of turn this thing around where they're willing to pay more for the calls, because the expectation in their mind is that there's going to get a big payout from a big move to the upside. And so what I thought was interesting about Marvell is Marvell has actually beaten its earnings for 8 consecutive quarters, but the results in terms of the stock performance the next day is all over the map. So it's been very spotty. You might think that, hey, you get an earnings beat 8 consecutive times, you're going to see that stock rally 8 consecutive times. Well, that's not the case. And if you look at what happened, there you go. You can see that big gap on that last earnings, where the stock really kind of tanked. And if you look at kind of that level, yep, there it is right there. Yep, you can see 2 different examples there. If you look at that level where we're at right now, we have rallied 50% from that last earnings low price of $62. After the shares sold off, 18% kind of on that earnings news. So we've rallied and we've actually taken out that previous high, and we set a new high, at least in that period. So going into earnings, which are actually coming out on December 2nd, if you own these shares and you've had that 50% move from the bottom, and it's hard to pick the bottom, but let's say you were waiting for an entry signal, you got above maybe that 20 or the 50 day, and you still have had some upside on that name, and you want to protect against a big move to the downside should it fail, to move up on earnings again, then a collar in this example might be the trade that you're looking for. So here's what I'm looking at. The 87 put in December 5 expiration. Why am I using the December 5th expiration? Because that encapsulates that earnings, right? So I don't want to do anything before that, because then I don't protect myself against the earnings drop. And if I go too far out, well, then the calls aren't going to be as expensive as they are right now. So the financing for the collar wouldn't be where it's at right now. I do this every month. I don't want to do this for the whole year. I just want to do it for one event. It's the event risk. So if I buy the 87 put in the December 5th expiration, and I sell the 105 call, I can actually do that for zero cost. Meaning, what I'm selling the call for, finance is buying that put, and there's actually no debit in my account at all. Gives me the ability to have that upside to 105, and then if the stock drops below 87, I'm actually protected for the move down below that because I'm long that put. And that's the type of stuff that we look at through our education. That's the type of stuff that we do on our webcasts with Schwab Coaching, is we show these kind of intricate, kind of hedging ideas. And you talked about credit spreads. I mean, that's the type of stuff that we talk about because that's the type of stuff that our clients want to know about.
Right. No, absolutely. And again, as you said, this is kind of what the big boys and girls do a lot of times, right? When you've got a huge pension fund, you don't want the volatility, and so yeah, this is how you do some of that protection. So maybe we talk a little bit about some of the places where people can go for this information. There's certainly the Schwab network. You mentioned the Schwab Trading Activity Index and
Yep.
things that are, and you guys speak on these things and kind of do the analysis of this data that you're sharing. So where can people find that?
Yep. So the group that I work with is the Schwab coaching team.
Mm-hmm.
And so you can find them at schwab.com/coaching. And we do about 35 hours a week of webcasts. You can go to YouTube as well. It's called Trader Talks. So just type in Trader Talks in YouTube and you'll see our whole collection. Like I said, we do 35 live hours a week, but then we have hundreds of hours of on demand. So
Wow.
if you're interested in what I was just talking about right now, just type in collar or type in
Mm-hmm.
protection strategies, and you'll find a litany of webcasts that cover that. You mentioned the Schwab Network. I think they are really really good because what they do is they have the ability to talk to analysts and CEOs and really just a great collection. I know that Michael Saylor was on there the other day, and Jim Cramer was on there the other day. So they get some really fascinating guests on that show. But even just going to schwab.com/learn, Learn, that's where you'll find all of the articles that we write. Colleagues like Liz Ann Saunders when she does like her market outlooks. These are things that I think would help whether you're an investor or whether you're a trader. Remember this, and I think this is really important, Justin. Investors are traders, traders are investors. They can wear both hats at the same
Right.
time. You can be an investor who says, I want to augment my returns a little bit by learning something like, just maybe some basic trading activities. When stock gets above a certain moving average, that's when I want to buy. Or maybe I'm a little bit more active and I want to reduce some of my downside risk by using trailing stocks, things like that. So these are things where you, as an investor, you can incorporate some of these trading strategies. And as a trader, look, traders, you got 401ks, don't you? You got IRAs, don't you? You need to understand some of that fundamental analysis behind the purchases that you're making. So I think we can provide the best of both worlds to as many segments out there.
Yeah, and I mean that's something that I think Charles Schwab, when he came up with the brokerage, certainly it got on my radar back in 1998, just because
Mhm.
the stock move from October 1998 to April 99 is one of our classic stock
Oh
moves.
yeah,
But yeah, there's always been so much education that Charles Schwab himself dedicated himself to, kind of like our founder at Investors Business Daily, Bill O'Neill, who did have a lot of respect for
absolutely,
Schwab as
absolutely.
well. So really appreciate all of the stuff that you do, Joe. And thank you so much for being on the show. Appreciate that as well. Okay, that's going to wrap it up for us this week. Thank you so much for watching, and we're going to have another Joe on next week. It's going to be Joe Fahmy. It's been a while since he's been on the show, so of course he's from Zor Capital. He's definitely one of those IBD methodology followers and uses Market Surge a lot. So we'll probably be diving into some of the ways he uses it and get his take on the market and what to do next for the volatility and the Fed coming up and everything else. So hope you join us for that next week. Thanks a lot for watching. We'll see you next time. Bye now.